Welcome to Investors Insights. Our topic today is the misery index in the markets. I am joined by my distinguished colleagues, Ty Miller, Bobby Norman, and Trey Booth, and we want to talk about the misery index in relation to your portfolio, the markets, and the economy. Now, let me just briefly explain. Back in the 80s, when inflation was rampant, there is an indicator called the misery index. It is the rate of inflation plus what unemployment is currently showing. And we're going to talk about that today. We think it's time to reintroduce that to people watching our blog, our podcast, Facebook, Twitter, LinkedIn. We want you to get familiar with this. So with that, I want to start off because, Ty, you brought up unemployment today. And currently right now, unemployment's around 3.5%. You agree with me on that?
That's correct.
Okay, so talk about unemployment, and then folks stay with us because Trey's going to talk about inflation, and then Bobby's going to talk about the positives that we're seeing with corporate America. So with that, Ty, go ahead and talk about unemployment.
Yeah, so we got our jobs report on Friday, even though the market was closed. Added 236,000 jobs. Unemployment rate fell down to 3.5% from 3.6, with labor participation rate rising to 62.6. So the labor force participation is the number of people working or actively looking for work. This is important because the only two ways an economy can grow is by increasing output and efficiencies or by having a larger working base. And so we're finally starting to see our labor force come back. Since COVID, it's been kind of depressed. I actually have some interesting charts here. It's the same chart, one from January and one from Friday. And as you can see, in that time span, we've added 2 million people to the labor force. We've added 2 million employed working people. And our number of job openings have fallen from roughly like 500,000. So we're starting to see improvement there. Back in January, we had like 1.75 job openings to unemployed people, and now it's down to like 1.65. The lower, the better in that rate. So we're making up ground. Lastly, about the jobs report that I'll bring up is average hourly earnings growth. It was 4.2% year over year. 4% increase in your pay is great. Everyone wants a 4% raise. However, as Trey's going to allude to, with inflation, things have gone up 5 or 6%. So we're still lagging inflation in that department.
In fact, right now, the last numbers for inflation were around 6%. So if we take a 6% inflation plus your 3.5 unemployment, the misery index is currently around 9.5. And we're watching that closely because it shows the amount of pain that people may be experiencing in their jobs and their lifestyles in this economy. It's a great gauge and also allows us to see, will the consumer move forward spending money? Will they retreat? As well as other things taking place in the economy. Now, Trey, you did a phenomenal job tying in to what Ty said to us here just a few minutes ago. Explain inflation and that the Fed may be raising rates even more. So talk about that.
Yeah, absolutely. So the inflation has definitely been the headline number that I think the U.S. consumer has felt. You can see it when you drive by the gas station, when you go to the grocery store. We're seeing it in consumer spending. The way the market looks at inflation, though, is how it relates to what the Federal Reserve is going to do. Will the Fed have to continue to raise interest rates? And this is a chart that those that have watched our vlogs are probably very familiar with, shows when will the Fed stop raising rates. And historically speaking, the Federal Reserve has stopped raising interest rates when the Fed funds rate is higher than the rate of inflation. As we sit today, the Fed funds rate is at 5%, and inflation, as Greg you alluded to, was the last print we got was at 6%. So the next Fed meeting will be May 3rd, but on Wednesday we get updated inflation data, and expectations are for consumer price index to drop to 5.2%. That's not quite the 5, but it's pretty close. And so if that number can fall in line with expectations or even do better, that could indicate that the Fed may be able to pause and stop raising interest rates. Or if it stays higher, then the Fed may have to continue to be aggressive in the face of weakening banking sector, higher prices, wages. And then that's the tricky part, is that wages are up, as Ty alluded to, over 4%. That's a great raise. Year over year, 4%. That would be a very good positive. But if prices are going higher than that, then that's where you get the risk of stagflation, where you have inflation moving faster than prices are moving higher than the economy can grow. And that's not a very positive sign. Now, that could be positive for corporate America because if prices are rising at 5%, if employment, which is one of the largest costs in corporate America, is rising at 4%, there's a chance they're pocketing that 1.5% spread. So something we're watching closely. It's very impactful on the market is what inflation will come out on Wednesday, and then how that's interpreted going forward to what the Fed's going to do. So these are the biggest data points we have before the May 3rd meeting. And so that's why it's so important for us to watch that. Can we bring that misery index down with these two data points?
Yeah, because that would bring it down from 9.5 to 8.7, and we'll take any drop we can there because that shows that people's lifestyles are more affordable, as well as based on the raises they're getting, they can actually either invest or spend a little bit more money in the economy.
That's right.
So that's a great explanation, Trey. And so with that, though, we want you to understand that we're talking about the misery index, but there's a lot of positives out there. And we're kind of at a pivotal place here as the Fed's looking at inflation, as they're looking at unemployment. And Bobby, you talked about that corporate America is holding a lot of cash right now. They've got a good stockpile, let's put it that way. So elaborate on that to let people know that this economy is moving forward as we speak.
Yeah, so with the current concerns in the market being around bank strength and some companies announcing layoffs recently, we are analyzing the current balance sheet of corporations to see if the concerns are legitimate. And one number we look at or like to look at is the current cash equivalent holdings of the companies in the S&P 500 as shown in this chart. So this chart provides a quarterly snapshot of the total cash and cash equivalent holdings of the companies that comprise the S&P 500, which to us is a barometer of financial strength. So broadly speaking, seeing the S&P 500 index cash holdings suggests that America's largest companies overall appear to be on solid footing, in our opinion. And it's also indicated in this chart, total cash and cash equivalents fell from the peak of $1.89 trillion in Q4 of 2020 to $1.58 trillion in Q4 of last year. But the decline may be related to share repurchases and dividend distributions in our view. So stock buybacks and dividend distributions for companies in the S&P 500 index each set record highs in 2022. Furthermore, companies will often utilize cash as they engage in M&A activity, invest in property, plant, equipment, among other capital expenditures. So in our view, the record-setting pace of both recent stock buybacks and dividend payments could be viewed as a vote of confidence by corporations in their ability to weather the current economic headwinds. So time will tell, but broadly speaking, companies in the S&P 500 seem well capitalized and gives us hope that the market can remain stabilized through the current noise in the economy.
I think that's a great explanation. When you see companies buy their own stock back, they're in essence saying we've got excess cash. Where can we place it? And we're going to buy our own stock back. That's big, or pay additional dividends to our shareholders. That's excellent. So we're watching all of this very closely. We're going to keep you updated throughout this week and on into the month of April. We also know that the end of tax season is almost upon us. So if you still need to make that IRA contribution, take care of any tax situations, information that needs to go to your CPA, don't hesitate to give us a call. We're here and we're ready to go into action for you. And so we appreciate you believing in us. And each and every day we walk through our doors at Five Plan Partners, looking to see how we can make our clients' lives better, richer, fuller. And hopefully the information on the misery index today gave you more insight on things you can watch as we keep you updated. Go and have a great week, and we'll look forward to talking to you soon. Thanks.